Welcome again, everyone. Welcome back to the second lesson in our four-part series. So as we get started, I'm just going to give the same reminder as I did last time for some general rules. Please stay muted during the presentation unless you have a question. If you have a question, please use the raise hand function under reactions, or you can type your questions into chat. I'll be pausing periodically throughout the session to ask if anyone has any questions. Also, the resource doc that Fian linked in the chat, that's where all the resources and guides that I'm using for these lessons will be found. So it's the same link every time. So if you just save that link, that'd be great. And of course, all these lessons will be recorded and uploaded to the NCAT's YouTube and websites after the session. So let's just go through another quick overview of where we are now in the series. So this is the second lesson. In the first lesson, we talked about some personal information with filing, such as what is your filing status, what is your dependency status, are you required to fill, and should you file? If you missed that first session, feel free to watch the recorded video on YouTube. The link to that is in the resource doc, and it was sent out in an email earlier this week. So now we're on to lesson 2, reporting income and adjustments to income. Let me reshare my screen to a W-2 form. Sorry, not a W-2 form, our 1040. So we went over the basic 1040 last lesson. We talked about how this is the classic individual income tax return form. And we're going through basically all the parts of the 1040 here. So last session, we were looking at, let me get a spotlight out. So last session, we covered filing status, which is the very top section here, some basic information about yourself, and the dependents section here. We did skip over standard deduction. That comes up later down here on line 12A. So we'll be getting to that in the next session after this one. And in this lesson, we're going to be talking mostly about income, which is this large chunk of the 1040 right here, and a little bit about adjustments. So let me go back to my presentation slides. Yep, we did our 1040 form. Where are we now? So let's talk a little bit more about income. You're all here at my Zoom because you have earned money throughout the year, and some of that money is taxable. Let's go over a few basic terminology with income. So I've highlighted 3 types of income here: gross income, adjusted gross income, and net income. Your gross income is the sum of all income that you've earned over the year before you pay any taxes or other deductions. So these include like wages, dividends, any capital gains, business incomes, retirement benefits, and all other sorts of income. Your adjusted gross income, or commonly known as your AGI, is your gross income minus certain adjustments. Your AGI is how much of your income is taxable, and it's usually lower than your gross income. So some adjustments that may be made to your gross income to make it your AGI include like educator expenses, student loan interest deductions, and other contributions through retirement accounts. Then finally, your net income is your actual take-home income after you pay taxes. So this is the actual amount of income that you use throughout the year after taxes. Moving on, let's talk a little bit more about taxable versus non-taxable income. There is a difference here when reporting income on a 1040. So your taxable income is counted towards your gross income and AGI. And it must be filed and reported on a 1040. If you have taxable income, you must report it on your 1040 form. Now, there are some types of non-taxable income. They do not add to your gross income or your AGI, and you can report them on a 1040, but that's mostly for accounting purposes, and they won't actually affect your taxes. So let's go ahead and look at a little table that I have that gives some examples of taxable versus non-taxable income. Again, all of these resources can be found on the Taxes 101 resources guide if you want to pull it up and look at it for yourself. So here we have just a very quick reference guide of some examples of taxable and non-taxable income. And please keep in mind that this is not an exhaustive list. This is just a few common examples. If you want to look at a more detailed and comprehensive list, again, links to that are on the resources guide. So for now, let's just look at some examples of taxable income. These will probably be very intuitive to everyone here. They include like wages, any cash income you make, dividends, any awards or employee bonuses, fees, gambling winnings, let's see, interests. You also have pensions, rewards or royalties, and sometimes taxable scholarships and grants. Now, for non-taxable income, these usually include things like child support, death payments, the economic impact payment, otherwise known as the stimulus check, that is non-taxable income. We have federal income tax refunds. So if last year you were owed a federal income tax refund, that's not counted towards your taxable income for this year. Gifts. So this would be like if you were going off to college and your uncle paid $5,000 towards your tuition, that wouldn't be considered your taxable income. That would be considered a gift that your uncle gave you. So you would not have to report that on your 1040. Let's see other things. Here's a very interesting one: meals and lodging for the convenience of your employer. So for me, I'm a resident assistant at Duke, which means that Duke provides some of my board and housing, and that is not considered taxable income because I'm given that meal and lodging for their convenience. Other examples of non-taxable income include any qualified Medicaid waiver payments, sickness and injury payments, some Social Security benefits. So again, Social Security benefits is taxable based on your AGI. So the higher your AGI, the more your Social Security is taxable. Student loan forgiveness is also non-taxable, veterans benefits, and any workers' compensations and similar payments. So those are just some highlights I wanted to showcase in this very handy table. Let's go back to our slideshow. And now let's get into some examples of income, common types of income, and the tax forms that are associated with them. Today, I'll be mainly focusing on 5 types of income, as I've highlighted here: wages, interest, and dividends. Those fall in the same category: capital gains and losses, retirement benefits, and self-employment income. And you can see their associated forms. So for wages, that'll be a W-2. For interest and dividends, either a 1099 INT or a 1099 div. You've got capital gains is a bit more tricky. Usually you find them on your tax reporting statements from your bank account or whatever stock trading application you use. For retirement benefits, we got 1099Rs and SSA 1099s. And self-employment income, Schedule Cs, 1099 NECs, and 1099 NISCs. Oh, wrong way. So let's start off with probably the most common form that everybody will most likely file on their taxes, which is your classic W-2. Let me share a mock W-2 for you so you can kind of see what this looks like. Well, here you go. So this is just an example W-2 that I've pulled from the internet. This is not a real person. This is just a mock W-2 for the sake of showcasing what a W-2 looks like and where you can find all the different types of wages and withholdings on the form. So let me bring out my highlighter again. Where did you go? There we go. So your employer will most likely send you a W-2 if you work like a regular wage and salary job sometime during tax season. Some people already have their W-2s out right now, or they might be coming out sometime later in like February, towards the end of February as well. Let's take a look at the different parts of the W-2. So in the box A here, this is where your social security number can be found. So employee social security number. Then in box B, this is your employer's identification number. It's like their social security number, but for their company. This is your address, or sorry, that's your employer's address. This is your address down here. We can see that this is a mock W-2 for a Wilma Jones. And now let's get into the specific boxes. So the most important boxes on a W-2 are probably box 1 and box 2. In box 1, you'll see your total wages for the entire year. So in 2021, Wilma made $42,000 in wages, tips, and other compensation. And in box 2, this is the amount withheld from Wilma's pay. So income tax withheld is when your employer takes your paycheck and withholds a little bit of it to pay towards your federal taxes at the end of the year. If you do not withhold any taxes throughout the year, and at the end of the year, you suddenly have to pay these taxes, there will be a small penalty for not withholding taxes throughout the entire year. So we can see that Wilma had $2,700 of income tax withheld from her pay. And then boxes 3 and 5 are usually the same as box 1. We'll see another example later on when they're not the same, but these are just any Social Security wages or Medicare wages and tips, and they usually are the exact same as your overall wages, tips, and other compensation. Then in box 4 and 6, these are the exact amounts withheld for the purposes of your Social Security tax or Medicare tax. And these are just usually automatically generated based on a certain percentile. Then as we keep on going down, there are more boxes that are usually left unfilled because they do not relate. And then we get to box 12A and 13. So 12A and 13 are usually used if you have any deferrals to a retirement plan, as the middle box here is any statutory employee or third-party sick pay. Usually most people defer their wages to a retirement plan. And the specific thing that they do with their wage can be found in box 12A with their code. So there are a bunch of different codes that just say that have like different meanings. For example, DD here is an employer-sponsored healthcare coverage, which is not taxable. So Wilma's employer sponsored a little bit of her health coverage, and that is not taxable. They sponsored exactly $2,300. There are a bunch of other codes. I've also linked a good resource if you want to see the list of codes on the resource stock. That's 12A, and 12A is usually directly tied with box 13. And then down here at the bottom, this is for your state taxes. So this exact state that you're paying taxes for would be shown here, and the state's ID number. This is all the total amount of wages that you've made in the state, and it is usually the exact same as box 1. And then in box 17 will be any state income tax withheld. So Wilma did not have any state income tax withheld, but if we scroll down a little bit more, I have put a second example of a W-2. This one is a little bit different. We can automatically see that boxes 1, 3, and 5 are not the exact same like they were in the previous example. The reason why boxes 3 and 5 do not match box 1 is because of box 12A here, we see a new code, code D, which is a voluntary deferral of wages to a 401k of exactly $1,000. And that's why boxes 3 and 5 are exactly $1,000 greater than box 1. So box 1 is all the wages that, in this case, Richard Cook made. And then for his Social Security wages and Medicare wages, we add on his voluntary deferral to his 401k, $1,000, and that changes his Social Security tax withheld and his Medicare tax withheld. So very important to know which codes you're using, or which codes show up on your W-2, what that means for your withholdings and your overall wages. And then we see down here in the state section that Richard does have state income tax withheld, unlike Wilma in the previous example. Does anyone have any questions about the W-2 form before I move on to another type of income?
What determines like how much state income tax is like withheld versus like if you do get any withheld at all?
Yes, great question. So usually this withholding is just a percentage of your wages. It's not usually something that you can actively keep track of, but you can ask that nothing is withheld from you. Same with your federal income tax. You can ask for no withholdings at all, but then again, you run the risk of having to file taxes at the end of the year and paying the penalty for not withholding any taxes throughout the year. But if you are sure that you are not required to file taxes at the end of the year, you can ask for no withholdings. And throughout the year, you can also ask for your withholdings to be increased or decreased. It'll just be a little bit more hassle and paperwork. These are usually like the standard amount. You start a job, they withhold a certain percentage from you. Does that answer your question? All right, so I'm gonna move back to my presentation. So we covered wages, which was found on the W-2 form. Now we're gonna move on to interest and dividends. So interest income is just any interest generated by your investments. Usually this would be like your savings account at the end of the year where you made maybe $5 of interest. And dividend income is a bit rare. It's for stockholders or shareholders of a corporation who get paid a portion of the company's profit. And what makes this a bit rare is that this can sometimes fall under capital gains, such as if you traded stocks, so which we'll be seeing after this. But for now, let me again reshare to a mock 1099 int and div. Whoops. Here we go. So here is a 1099 div. All these wage forms look pretty similar. They are all like the box shape, have little subsets of boxes. It shows looking carefully at what each box means. So first we have our basic information, the exact payer, usually this would be your bank, their identification number. This is your identification number, otherwise your social security or ITIN, and then more basic information such as your name, street. There we go. And now we look more at the numbers in the boxes. So usually the only boxes filled on a 1099 div are 1 and 4. 1 is your total amount of dividends. I should probably make this clear that a 1099 div is for dividends and distributions, while a 1099 int, as we see down here, is for interest income. So for dividends, we have total ordinary dividends and qualified dividends. These are usually the same amount, and they're just the dividends that you've earned for the entire year. And the box form, which has been nicely bolded for us to pick out among all the boxes, is how much of your dividends were withheld for the income tax purpose. That's usually the only boxes that are filled on a 1099 div, pretty straightforward. We can scroll down to the 1099 int down here for interest income. Again, there are usually only a few boxes filled out for this too. Box 1, box 2, and box 4. So box 1 is your total interest income for the year. Box 2 is if there's any penalties for early withdrawals. And box 4 is federal income tax withheld. We can see that Richard Cook here had 0 income tax withheld from his interest income. Pretty straightforward, rather simple, but not all banks will give you a very nice 1099 int or 1099 div. Sometimes you can get alternative forms, to put it that way. Let's look at a bit of an alternative. So instead of a 1099 div straight up with the nice boxes, sometimes you can get what is more commonly known as a tax reporting statement from your specific bank. And in this, you can find a bunch of forms squished into this one like long receipts looking document. We can see here that this is form 1099 div. It's basically the exact same thing. We have total ordinary dividends, qualified dividends, which both are here, and any federal income tax withheld, which is line 4. No federal income tax withheld. There's also a 1099 MISC in the mix here. 1099 MISC is for self-employed people, so we're not going to cover that just yet. And down here we have a 1099 int. So again, interest income, we can see that the interest income for this person was $250. They do not have any early withdrawal penalties or any federal income tax withheld. And then down here at the very bottom, a very quick summary of any capital gains. For this person specifically, it was stocks and bonds, but this is not enough to file taxes for capital gains and trades. We're gonna see that actually right now. Let me go back to my slides. Capital gains and losses. So capital gains and losses, there isn't a specific form like a W-2 or a 1099 int to record these. Instead, you have to look more closely at like the specific gains and losses that you've made throughout the year. So going back to my mock forms, here is an example of maybe what you'll see. And this is specifically for stocks. So again, this is another tax reporting statement from a bank and an investment. And here we can see proceeds from broker and barter exchange transactions. And as we look through this, it looks a bit messy at first, but we will be able to find a lot of good information that we will need if you are going to file any capital gains and losses. For most people, capital gains and losses occur because of trading stocks or other sorts of investments. So right here in the first part, we have a short-term transaction in which the basis is reported to the IRS. We can see that the name of this investment is Iowa Co. Common Stock. And we'll see the date acquired, the date it was sold, and how much quantity of sold. And probably the most important part is the cost and the proceeds here in box 1D and 1E. So the cost would be how much you originally bought the stock for, and the proceeds is how much you sold it for. We can see that this person here made a profit of $650 from buying and selling the stock. And then down here, further down, we have a second stock. This one is the same kind, Iowa Common Stock, but the dates are a bit different. So this person bought this stock at a different time. You can see that this is a longer time frame than the previous one. The previous one was bought and sold within the same year, while this one has been kept for over 10 years. So in this case, this would be considered a long-term transaction. for which basis is not reported to the IRS. Now, not reported to the IRS does not mean you do not have to file this or report this on your 1040. This just means that the IRS has not kept track of this basis because it's been such a long time frame. It still does need to be reported on your 1040. And so we see the proceeds, it costs again, and this person has gained $1,400 from trading this stock. So all these would be inputted into your capital gains and losses section of your your 1040. And this person was lucky enough to have made gains on both of his or hers stock trading. But if, for instance, you made a loss, a portion of that loss might be deductible from your income. And we'll talk a little bit more about that when we get into credits and deductions in lesson 3. Does anyone have any questions about this before I move on to retirement benefits? No questions, that's okay. So I'm just gonna go ahead and move on to retirement benefit, which would be from a 1099-R or an SSA 1099. I'm a little bit annoyed why they made it SSA 1099 and didn't keep the same format as before where the 1099 goes first, but it's all right. We're gonna breeze through this section a bit faster because I feel like this does not apply to the majority of the participants here, at least not yet. So let me again reshare a mock 1099R and then SSA 1099. So this is a 1099R. The difference between 1099Rs and SSA 1099s, you can see here's an SSA 1099. This is specifically for Social Security benefits. So SSA means Social Security, and then 1099Rs are just retirement accounts in general, excluding Social Security. So pensions, retirement saving plans, or IRAs, these would all go under a 1099R. So again, it looks like your common income form. We have specific boxes that are more important than others. So the first box is always going to be your gross distribution. So how much retirement benefits you received in total throughout the year. And box 2 is the taxable amount of your retirement benefits. Because again, the total amount of retirement benefits, especially for Social Security, may not always be fully taxable. And here we have a blank taxable amount box. This does not mean that none of your retirement benefits are taxable. It just simply means that they did not take the effort to calculate that. So now you have to calculate it yourself. You can see here in box 2B, taxable amount not determined. So they did not calculate it, which makes it a bit more difficult for the taxpayer, but there are ways to calculate that amount. I have put links to that in the resources too, I believe. And then of course, box 4, federal income tax withheld. And we also can see down here in box 7, another distribution code similar to what we saw in a W-2. So this gives you an idea of why exactly this was distributed. So code 7 is just a normal distribution. That means your retirement savings are fulfilled, you've reached the appropriate age, and now you can take a normal distribution, no penalties at all for early withdrawals. And an additional box down here, 9B, any employee contributions to your retirement benefits. That's a basic 1099R. We're going to move down to an SSA 1099. Actually, before we do that, I want to talk a little bit more about the distribution codes. In box 7, I forgot to put another example for this, but if you see a distribution code of 1 in box 7 for your 1099R, that means that you took an early distribution out of your retirement savings, usually maybe a 401k or an IRA, which is an individual retirement account. if you take an early distribution, you usually face around a 20% penalty for withdrawing too early. However, there are certain exceptions now, especially during the pandemic, where you will not face that penalty if you make an early withdrawal. So for IRAs currently, if you made an early withdrawal because of COVID-related hardships, or for example, qualified higher education expenses, you would not face that 20% penalty. And I've also linked resources to that to determine whether or not you qualify for an exemption in the resources doc. But yes, pay attention to any distribution codes on any of these income forms. And now for the SSA 1099, this is a classic Social Security benefit statement. It looks a little bit different than all the other forms that we've seen so far, but it has the same basic function. So we get benefits paid in 2021 in box 5, which is the bolded box here, the total net benefits paid, which is usually the same as box 3, but sometimes in box 4, we'll have benefits repaid if they were overpaid in previous years. So box 5 just accounts for any differences between those two boxes. And then here in this larger box, we get a more detailed description of the amount of box 3. We can see that a part of it was used for Medicare Part B premiums, and then the rest benefits for 2021. Box 6 is any voluntary federal income tax withheld. So this is completely voluntary. You can choose whether or not you want to withhold any depending on your estimations of how much tax you might owe at the end of the year. So that was just a quick overview of retirement benefits. And then we have self-employment income. So self-employment income can get really tricky. It involves this very extensive Schedule C, a bunch of different deductions and tax credits and other additional business taxes associated to being self-employed. So to avoid opening that can of worms and getting too deeply into that, I'm just gonna skip over this section. If you are a self-employed person, I have resources to any of those forms that you see down here in the resources doc. And while I'm here, I also have just a few bits of advice for self-employed people. The two big ones is one, keep track of your business expenses with either logs or receipts. And when I mean business expenses, I mean anything that's needed for your work, such as business cards, supplies, maybe a uniform. These could all be counted as business expenses. And then second, log all of your business miles traveled in a vehicle that are not commuting miles from your home or to your job. So both of these can be deducted from your taxes. So it'd be really advantageous to you if you kept track of both these things. That's just my little piece of advice for any self-employment or if you're working through a Schedule C, because that can get pretty tricky. And so I'm going to avoid that for now. I do not want to get too deeply into that. So moving on into adjustments. Remember that adjustments reduce your AGI, otherwise known as your taxable income. So the adjustments are very few because a lot of them fall under deductions and credits instead, which we'll be talking about next lesson. And so the few relevant adjustments that I picked out are the student loan interest, educator expenses, and the health savings account. So let's start with probably the most common one, which is the student loan interest. Usually you'll find this on a 1099-E, which I will pull up a mock 1099-E right now. Or actually, we're going to look at this chart first, then I'll pull up the 1099-E. So let's look at the requirements for student loan interest deduction. You see that it's called a deduction here, but it technically falls under adjustments. Again, adjustments, deductions, they can kind of go either way. That's why there are very few adjustments, because most of them just end up going under deductions. Okay, so for student loan interest, the maximum benefit that you can deduct is $2,500. For you to be eligible for this adjustment, your loan you must be legally liable for this loan, and it must be taken out solely to pay for educational expenses. It can't be from a related person or made under a qualified employer plan either. And for the student who's taken out this loan, that student must be either you, your spouse, or a person who was your dependent when you took out the loan, or would have been your dependent, except for you were the dependent, or if you had gross income over the exemption amount, or if you filed married filing jointly, which is the MFJ here. The student must also be enrolled at least half-time in a program leading to a degree, certificate, or other recognized educational credential. And for the time limit on the deduction, you can deduct interest paid during the remaining period of your student loan. So throughout your time repaying your student loan, you can always take this deduction. We'll see in our next lesson that there are certain credits and deductions where you can only take a certain amount of times during your life. So it's definitely worth paying attention to the limit on these deductions and credits. And of course, there is a phase out depending on your AGI here and your filing status. We can see in a tiny note down on the bottom of the page, taxpayers cannot claim this deduction if their filing status is married filing separately, or if the taxpayer or spouse, when married filing jointly, is claimed as a dependent. So just a little caveat here. We can see again why married filing separately is objectively the worst filing status out of the 5. And now let's look at that mock. Do I have the mock 1099? We put up. If not, it's definitely under the resources. So I'll pull it up from here. Here we go, mock 1099-E. So this is a student loan interest statement. Let me zoom in a tiny bit more so that we can see this better. There you go. It looks like your typical form. So we'll find the basic information here about who was lending this. This would be your social security number here. You are the borrower. In this case, the borrower is Cynthia Simon. And then really the only box of interest here is box 1, which is any student loan interest that you've been paying for the past year. In this case, Cynthia has paid $3,570 in student loan interest. So pretty straightforward. Again, 1099-E. Any 1099s you see here would be from in terms of educational expenses. Now let me go back to my presentation slide. I actually have a practice problem that you guys can work on. Next, this is a student loan interest scenario. Here we have Emma, who is the dependent of Alice and John. Alice and John are both filing a joint return this year. I should have put another note here that says none of them can be, Alice and John cannot be claimed as a dependent. So Alice and John are filing a joint return this year and they cannot be claimed as dependents. But Emma is the dependent of Alice and John. Emma is also a full-time student pursuing a BA in psychology. Emma has a qualified student loan and is legally liable for it. Emma also paid $3,000 in student loan interest during 2021. So the question here is, who can claim this adjustment? And what is the largest amount of student loan interest adjustment they can claim? I'll give you guys like 5 minutes to try this problem out on your own. You can find that helpful chart that I was mentioning earlier in the resources doc to reference. And I'll just keep the scenario here on the screen so that you still have it. All right, I hope everyone had a chance to try out that problem on your own. Let's go over it now together. So I'm going to stop sharing the slide and instead move over to the chart that we were looking at earlier. If you want to take a picture now of the scenario so that you still have it when we move, feel free to take one now. Otherwise, I'm going to be sharing my screen again. Let's see. Here we go, student loan interest deduction. So let's go through all the bullet points that were on the previous slide to see if any of them qualify for this deduction, the student loan interest deduction. So first off, we have Emma is the dependent of Alice and John. All right, so this falls under student qualifications. The student must be a person, you, your spouse, or a person who was your dependent when the loan was taken out. Okay, so Emma is the dependent of Alice and John, so this is, Emma still qualifies for this deduction. The second bullet point we have is that Alice and John are married filing jointly, and none of them can be claimed as a dependent. So for the dependent part, at least they can still claim the deduction because they're not married filing jointly. Then we see here, you, your spouse, or a person who was your dependent when you took out the loan, or would have been your dependent unless they were married filing jointly. This doesn't really apply to Emma because Emma is not married filing jointly. That's only Alice and John. Then we have Emma is a full-time student pursuing a BA in psychology. So she is enrolled full-time in a program where leading to a degree, which is her BA. The next bullet point is Emma pays $3,000 in student loan interest during 2021. So that's a certain amount paid. And Emma has a qualified student loan and is legally liable for it. So that means that the loan qualifications are met and the student qualifications are also met. So the interesting question here is who can take the deduction? This is a little bit tricky. The answer here is either Emma or Alice and John. Since Emma was the one who actually paid the student loan interest, she is also able to claim this deduction. But if she wants to give this deduction to her parents instead, Alice and John, that is also acceptable since she is their dependent. So a little bit of a trick question here, but either of them can take that deduction. I guess it would depend more on for whom it is more beneficial. And then for the second part of the question, what is the largest amount of adjustment that is possible to claim? For that, we just need to look at the maximum benefit amount again. The maximum benefit for this specific adjustment is $2,500. So even though Emma paid $3,000 in student loan interest, she can only claim up to $2,500 in the adjustment. So that is the cap on the deduction. Does anyone have any questions about that scenario before we move on? If not, I am going to reshare my screen. So again, here are the answers, either Emma or Alice and John, depending on who wants to take that adjustment, and the largest amount, which is the cap of $2,500. And now that we're done with student loan interest, let's move on to the second most common adjustment, which is educator expenses, specifically for teachers of K through 12 students. This is usually the most common one. Let me reshare my screen. We're not going to spend too much time on this one because I also feel like not many people who are watching this Zoom right now are a teacher of K through 12. So we're just going to highlight a few important things and then move on. Oh, saw the spotlight. There you go. So the maximum benefit for educator expenses is $250 for a single taxpayer and up to $500 if both the taxpayer and the spouse are eligible educators. So what are eligible educators? In the next box, we see an eligible educator is a K through 12 teacher, instructor, counselor, principal, or aide who worked in school for at least 900 hours during the school year. This is a big kicker here, and is often the big limitation of this adjustment, is that they must have worked for at least 900 hours. So many substitute teachers do not qualify for this adjustment. And there are some qualifying expenses too, such as anything that's ordinary and necessary to education, such as books, supplies, and equipment. This could also include any computer equipment, softwares, or services, anything else in the classroom. If we scroll down a little bit here, for 2021, qualified expenses can now include any personal protective equipment, disinfectant, or other supplies used to prevent COVID. Some non-qualifying expenses include anything for homeschooling or non-athletic supplies for health and physical education. So these qualifying expenses will determine how much of the adjustment that you can take. You can deduct up to $250 of these expenses for a single taxpayer, or if both taxpayers and spouse are eligible educators, they can deduct up to $500 of their qualifying expenses. So this is a pretty simple, straightforward adjustment, very specific to educators. Oop. Let me reshare my screen. So that was educator expenses. There's not really a specific form for that. I would just recommend, if you are an educator, to keep track of those expenses through receipts or logs so that you can take that adjustment at the end of the year. And lastly, we have the health savings account. So similar to a Schedule C, a health savings account can get really messy. And I don't really want to delve into that in too much detail right now. If you are aware that you have a health savings account, feel free to check out the resources doc for better instructions on that. It shows that there's a lot of different things that can go into a health savings account in terms of qualified medical expenses. So this is usually something that does not apply to many people, and I'm just going to skip over that right now for the time of for the sake of keeping everything at a more basic level. But do know that this adjustment exists if you are aware that you have a health savings account. So that will be it for me today. We ended a little early, but that's totally okay because next time we're going to be getting into some really interesting stuff, such as the most common credits and deductions that you can take that would really help out your tax return. So definitely look forward for that session. We're going to be talking about who's eligible and how much deduction and credit you can claim. So for now, thank you everyone for coming to this session. I hope you learned anything. If you have any questions, feel free to ask now since we have some extra time left over. I can stay on for a little bit more and answer some more specific questions you might have. So thank you, everyone, and see you next time.